In 2008, legendary investor Danny Moses made billions off what is now known as the Big Short. And in this episode, we take a look at what Danny's predicting to be the Big Long.
And the big question is this: the green rush was a $10 billion industry last year. Experts say it's going to be worth over $20 billion by the end of next year. How do normal people like us, who didn't cheat by being born into the 1%, how do we use the money from our own pockets and participate in this massive wealth creation event while building financial freedom for ourselves and generational wealth for our families? That is the question. My name is Charles. Join me
as we explore these answers. Thanks again for joining us on another episode of Green Rush Investing. My name's Charles. I've got my co-host, Courtney Richardson, the IV investor. You're in a new spot today. How are you?
I'm good. I am in a new spot. We'll see how this works. I may have to go back to my old spot.
So. Oh, nice. Good to hear. But I wanted to share with you, I don't know if have you ever heard of the movie or the book, The Big Short?
Yes. Actually, I was working when all of that happened. I was working as a stockbroker at Merrill. So no, I'm very familiar. I actually told a friend of mine when it first came out, I was like, I'm not watching that. But yeah, I'm very familiar.
Yeah, because you'd mentioned you'd been hit by the housing crisis and everything.
Yeah.
But bringing it back, do you know who Danny Moses is? Have you heard of him?
I do.
Yeah, so I was watching CNBC, and for everyone who may have heard of Danny Moses or may not, he's notorious for a book that was written about him by Michael Lewis. He's a great author, does all sorts of financial books, and it got so big that they actually made a movie out of what happened. So it won an Academy Award for Best Screenplay. And basically, Danny has notoriety because he was one of the first guys to call and not just say, hey, something's going to happen, but they made a big bet on the subprime mortgage market. I think it was starting around 2005 is when they basically realized, oh my gosh, this entire industry is being packaged on stated income loans and it's a house of cards. And that's what they did. And they made a fortune shorting the subprime market. And more importantly, it was interesting is he was on Fast Money, CNN show. I'm not sure if you watch CNBC on a regular basis, but I try to tune in. And he was on to talk about the cannabis industry. And at first, obviously, Courtney, you hear you and I talk about how whether it's Tilray or Canopy Growth, that we're on maybe a little bit of a bubble. I was expecting him to be on to say, hey, something's got to blow or something's going to go. But what was interesting is he was on there saying, hey, cannabis he's calling it the big long. Now, I'm not sure if that's just a marketing term or whatever it is on that side. But most notably what he said was he is saying that there's actually more money to be made in this industry than what he thinks anyone would be making off the 2008 financial crisis. What do you think of that? I mean, that's a pretty bold statement.
Well, you know what? And I think that's it's so funny because I'm still looking for my manager. So when we were working in February, we saw this happening, February of 2008. And I said, we have a problem because we have an over leverage issue. And so now I'm kind of like, so I was like, so I didn't call the Big Short, but I actually called it was a real serious problem in February of 2008. So then for this guy to come on and he said basically the same thing we've been saying over the last couple of months, I was like, wow, we're smart as we think we are. So it was because he basically echoed everything that we've been saying. So it's like, yes, we're completely on the right track. This guy has been doing this for years and he completely is just like, yeah, these are the things, everything that he said in the conversation is everything that we've been saying over the last, 2 months. I mean, at least in our conversations and been.
Oh, no. I agree. I think there's definitely, I don't want to make it sound like I need external validation, but external validation is kind of nice, right?
Yeah, exactly.
This is a guy, he's not just some person, not that, you're a person or I'm a person, but I mean, like, this is a guy, he's a hardcore Wall Street guy, right? He's been in the business for a while. They made a movie about him. And he's not just saying it's big. He's involved in a private equity fund targeting growth drivers in the cannabis industry. They also recently started a new investment fund called Moses Ventures to focus on cannabis. And what I found interesting, and I want to just kind of I'll summarize what I watched, and I think it's a great conversation for us to get in, is that in his Fast Money appearance, Moses picked out several key elements that what he believes make the cannabis industry an outstanding sector in which to go long. And these are things I didn't think about, but when he started saying, hey, there's this, or hey, there's that, it really made me say, oh my gosh, the guy's right. I mean, this is great. I mean, it's amazing. And I'll go back to what he was talking about. Basically, like, the first thing he said is, I've never seen a sector that has the political tailwinds, the economic tailwinds, the wellness tailwinds, everything that's blowing in the sector. And I mean, that's, I think, stating the obvious, right? We all know that this is a plant that has significant medicinal properties. It solves problems that people have been trying to solve with opioids. We also see the trend towards legalization. I actually saw a tweet. I forget her name. She's the Minnesota congresswoman, the one that's, I think she's Somalian.
Okay.
I think Iran, something, not AOC, but another one. But I mean, she tweeted something about cannabis and everything, and it seems like the entire Democratic Party is, and it's not, I think it's actually might even be bipartisan, that, hey, legalization or some sort of medicinal legalization or some sort of lessening of the rules in place makes sense, right? And that's a major political tailwind going out, especially if you think back, 20 years ago, back in the Bill Clinton days, I did not inhale, right? Or whatever that came up on that side. So, going back, what Danny Moses said was he was comparing cannabis against the housing collapse. And this is a guy that made, I don't even know how, he probably made billions, if not more, off the housing collapse. What he pointed out was shorts only go to zero, but longs can go to infinity. And what he means by that is the upside is unlimited. And basically, he said something interesting, saying that multi-state operators, and specifically U.S. operators, not the Canadian guys, but the U.S. operators present an interesting case due to the fact that capital lending in that space is really high. You can't go to a bank because of the murky legal status. Mm-hmm. And a lot of these companies, and we talked about that last week with even Canopy Growth, a lot of these companies don't have very much debt. They're all equity funded. Their balance sheets look clean and everything. And if you kind of summarize it, right, housing markets were under-regulated and over-leveraged. And that's why he went short. He said, okay, not enough regulation, too much leverage, something bad's going to happen. And he is saying this sector is the flip side, where the cannabis sector is under-leveraged, under-leveraged but over-regulated.
Correct.
And in that scenario, when you're talking about all that, that is like, it's ready to explode. And he's just saying, hey, whether it's, I don't know, the States Act or some of these other acts out there, if one of those goes through, as the cost of capital drops for these U.S. companies, he thinks there's a very interesting play. How that end?
So I think one of the things that I agree with kind of your summarization, I think one of the things that really caught my ear is that, and this is something I think we've been saying this for a while, is that they are giving the cannabis companies are giving too much of themselves away. Because they don't have that debt financing option, they're giving away equity as a way to infuse cash into their business. But then the question is that are you giving too much value away, basically because you're stuck in this kind of murky waters in terms of not being able to get any debt, which I think it makes for a very clean balance sheet. But I think it does down the road lead to some dilution problems. I specifically have talked about CV Sciences. They have a dilution problem. But I think this kind of opens up a bigger issue that I think we're starting to see across the board. It's like, and how do we fix these situations where a lot of debt was issued and maybe, a lot of equity was issued, and then you have some convertibles. So they're kind of like a debt equity hybrid. So yes, it's kind of like debt, it's private debt, but it has the opportunity to switch over to equity. And then what does that do for share prices when everything starts to go up? Like, what does that do for your existing regular everyday shareholders? So does that change, how does that change their experience in the cannabis world in terms of their investment? And I think those are things that he kind of made mention of it. And I was just like, ooh, I've been saying this, but the way he articulated, I was like, you know what, he's really right. And I am slightly concerned. So I think there's like, the sky's the limit on the industry, but I think I'm really concerned about kind of everybody who has their hands in the pot.
I agree. So what I thought would be a fun exercise today is, I think, we've looked at a lot of these Canadian operators, and I don't know if I don't have, I've got some examples on mine, but I thought we would just kind of wing it. Let's take a look at some of these U.S. operators, some of these U.S. multi-state operators, and see what we find, right? See if we can find any hidden gems or any hidden gold. I've got one I was going to start with, or do you have one that you've been looking your eye at, Courtney?
I've given a couple of looks to Curaleaf, Acreage, Green Thumb, and Medman.
Okay, let's just start with Curaleaf. Let me just share my screen and pull them up.
And I think by market cap, they are the largest.
Are they really? Okay, so hold on. Let me share my screen here. So I've got a bunch of windows open, and Curaleaf, we'll look them up. Curaleaf Holdings. Okay, their stock symbol is that right? Cannabis Global?
No, they are CURLF is their symbol.
CUR. Let me stop my screen share real quick while we pull this up. Okay, so Curaleaf. So
as you're pulling that up, they have, as far as my research shows me, I've talked about them a couple of times. They have about 28 dispensaries, and they're in 13 states. So in terms of multi-state operators,
these people, they're legitimate. I mean, they're real, right? They're not just kind of hanging out. So I'm pulling up their webpage. We've got that on one end. And let's look at the good old Yahoo Finance stock chart on the other end. Okay. So sorry, why don't you kind of give us an overview of Curaleaf? They're out of Massachusetts, it looks like.
Yeah, so it's vertically, like most cannabis companies, as they stand right now, they're vertically integrated. They've been running their growing operations. They have 28 dispensaries, last I checked, in 13 states. From what I understand of their kind of value to the industry is that they have the largest footprint of branded retail stores in the country. Now they did, and actually in the conversation about the cannabis big long, is that we talked about these RTOs, which are the reverse takeovers. And so they did a reverse takeover of Lead Ventures, which was a mineral exploration company in Canada. So that's kind of like where they are. So again, as we know, because they're not legal in the United States, they can't go public on the NASDAQ or the New York Stock Exchange. So they and the same thing goes to the Toronto Stock Exchange. So they go to the, I guess, for lack of a better term, the next best thing, which is the Canadian Securities Exchange. So that's where they've been trading after they did that reverse takeover in October.
Well, it looks like these guys, they're serious. 2 days ago, they just bought another Vegas operator. It looks like they've got a market cap, so $3 billion. So let me just, take a look at it. I'm always a financial guy, right? So I just want to see how the numbers look. How are they doing?
Not too bad.
Okay, so they're doing 21 million was last quarter. Not sure where they're at. Good gross profit, obviously. Definitely not on the profitable side of things, but I guess there probably is a method to the madness. They used to be profitable at one point, And then
before they started buying everything. And I think that's kind of the story for a lot of these cannabis companies. As they really try to expand their footprint, they start getting to the place where they're starting to operate at a loss. So I think they do have as you can see, they are in all the major areas. That's where they're located. You know, when we talk about, Florida is really big. California, of course, we know is big. So they're in like major areas, which is a good thing. But I think one of the questions that I've always had about this particular company are they moving too quickly?
So if you're looking at a company like this, right? And honestly, I probably haven't done the same amount of research on the U.S. MSOs as you have. What are you looking for, right? You know, you see Curaleaf. Obviously, they've got a footprint. There is definitely a major amount of speculation here.
Mm-hmm.
I'm looking at their balance sheet. I mean, they're sitting on $48 million in cash, so they're pretty well funded, at least for the short term. And if I go back to that income statement, right, you know, they are spending it though. That's for sure.
Right through it.
You know, they're definitely spending it. So what are you looking at when you're looking at Curaleaf? Or do you like them? You're still unsure? You know, what sort of angles are you looking at?
So what I look at when I'm looking at these companies overall is I look at where they are in terms of their 52-week high. Like I first look at where are they in the range? That's like always my first thing, because I just want to know, like, should I even be paying you any attention? Because
let's pull up the chart. So you're saying pull up the chart, basically.
Yeah, I always look at the chart. That's where I start my inquiry, just to see where they are. I always want to look at their market cap. Like I said, their market cap's about $3 billion, which is relatively respectable. But you can see where they took that little nosedive in December, where everybody took that nosedive in December.
Yeah, they came out. It looks like, did they IPO at like $7 or $8 or something?
They did that RTO in October.
Oh, okay. They started in October.
Yeah. So, I look at that. They're kind of like their range, I believe, is, I think they're not smack dab. They're like almost kind of smack dab in the middle of their range. So their bottom was, I think, 388, if my memory serves me correctly.
Yeah, it looks like it's 420. The big nosedive. Well, I don't know. It might get better data. It looks like 402.
There's that. Yeah, there's the low right there.
Oh, there we go. 388. Yeah.
Their high was 945. So they're like 6 something. So it's kind of like right in the middle. So I'm like, okay, you're right in the middle. That makes it look like a decent prospect. Because when I tell people, when I have conversations about investing, it's more likely that a company is going to drop outside of below. If they're at the top of their 52-week high, it's more likely they're going to drop down than it is they're going to go up and break through the high, usually, unless something major happens. And I mean, and at this point they may, because there's so many things in the works. So there could be this kind of major point of breakout. So that's what I start looking at first. And then I kind of look at the numbers like we just did. Okay, you look okay. I'm kind of interested in you based on your share price and where you are in your range. But like, what are you doing? And as par for the course, they are running through cash. And then my question is, what are you spending it on? Like, why are you running through cash? Well, you're one of the biggest operators in the nation. And you basically have kind of like this, I don't want to say invisible overhead, because it's very visible, of kind of dealing with all these regulations. And it's costly to deal with these regulations, and it's costly to kind of bring something up, and you have problems kind of moving your materials because it's illegal. So I'm like, okay, you're trying to basically take over the world. And that comes at a cost, or comes at a price. So I was like, okay, I'm not as interested as I was in CannTrust, here. Like if I had to put CannTrust here, which is the Canadian company, or I look at Curaleaf, like which one do I like more? I'm going to say I always like CannTrust more. And it's not just, and some of it's just because it's operating in a legal field, but some of it's just that I think they have a better kind of gauge of what they're doing, if that makes sense, on the Canadian side. So I feel like it's
dive into this a little further. I kind of like I like the direction you're going, and I'm honestly curious, right? So when we looked at CannTrust, there was a pretty defined market for what CannTrust had or was, right? And we looked at, call it, variations of value price to revenue, price to sales was the ratio we were looking at. We said, okay, the stock's worth, I think, $800, $900 million, or at the time, maybe it's worth $1 billion now. And that based on the revenue run rate of where it was, I think similar, it was actually at a similar revenue run rate to Curaleaf, if I recall. Let's just pull this up. Curaleaf did, I think CannTrust did like 20 million or something also for the quarter before reporting. So those were comparable. Mm-hmm. And my conclusion was that CannTrust was relatively cheap because as a ratio compared to, say, Tilray or Canopy Growth, I think CannTrust was at 9 times annual revenue and Canopy Growth is at 50 or so, some big number, right? So now Curaleaf, my first glance would say, oh my gosh, why would I even look at them? Because Curaleaf is, 21 million? So let's put that at 80 million. And you're trading at 3 billion, so that's probably almost, let me just double check. It's trading at $3.1 billion, so we're talking 30 times annual revenues, which is a huge number. But then I'm looking at their footprint, though, and I'm thinking of what you're saying. Their footprint is actually pretty large, and they're in some, you might call, pivotal states that could go really big, right? Let's just zoom in a little bit on here. So if I look at, right, they're in California already. It looks like they're in Nevada. But between Pennsylvania, New Jersey, and New York, that are all kind of big and hot markets, I mean, that could be pretty interesting. And maybe there's even more growth potential on that side. I don't know. I haven't really dug into Curaleaf as much as you, but what are your thoughts? I mean, like, there's got to be some, there's obviously, I mean, ultimately we care about revenue, right? But the reality is we are all betting in this stage, or not betting is too strong a word. I think we are all speculating that there is some amount of growth potential, right? It's all weighed on growth potential. So if you've got a company, say like Curaleaf, that might not be as strong revenue-wise, but has a massive footprint that could set it up for growth, do you handicap that a little differently? Do you factor that in? I mean, how would you go about looking at that?
It depends. It depends on how mature they are in those markets, if that makes sense. So that's kind of what I look at, is that I can look at your map. I can look at where you are, but it's a question of where are you in that market, and that's kind of going to tell me how I'm going to treat that exposure. Does that make sense?
Yeah, no, I hear you. That being said, it looks like, they have 12 states, 42 dispensaries, 12 cultivation sites. And then looks like 2 days ago, they just did another deal with Acres Cannabis. And they paid $70 million, 25 in cash and 45 in stock. Mm-hmm. And that's going to expand them with 42,000 square feet of greenhouse space and almost 250,000 square feet of outdoor cultivation. Okay. So it gets them ultimately, when the production's built up, close to 100,000 pounds of dry flower a year. And they have a cannabis dispensary in Vegas that's adjacent to the Strip. Mm-hmm. A second dispensary under construction and open later this year. Huh.
So that, to that end, it's very similar to MedMen, kind of how they're operating in that Vegas space. And I just can't, because I haven't been out there, I can't get a gauge on it. Like MedMen, they're like kind of far down on the list in terms of market cap, but in terms of their experience, like I can't speak to Curaleaf's experience. Like MedMen it's all about the experience, and all you ever hear about with MedMen is their experience, the experience of being in the store. But here, I'm just not getting that vibe. So I'm kind of like, so what does this look like? Like, what does this really mean? And that's what I meant, like, kind of what are you doing in the markets that you're in? Like, it seems like you're in poised positions, but I'm not really sure. And then they have a pending Pennsylvania license. I'm not really sure what's going on exactly there. So so there's a lot of opportunity with this company, and I think all we can do is this analogy to these Canadian players. When I look at Curaleaf, I'm looking more like at like I would look at Canopy. You know, it's kind of like there's a value of being the biggest kind of elephant here, or the biggest kind of mover. And I think that's what this company has. If nothing else, they are in the spaces where everybody wants to be, and they're pretty much kind of, I think they have the ability to penetrate more so than anyone else as it stands right now. Acreage is kind of really, Green Thumb is actually right under Acreage, but their Green Thumb and Acreage are like right under them. So they could at any point, you know, kind of overtake Curaleaf. So I think those are things to look at.
Well, let's take a look. Let's compare now. We've looked a little bit at Curaleaf.
Mm-hmm.
Why don't we pull up, and my computer's acting a little slow, so give me a second here. Why don't we pull up Acreage for a second and see what we know about Acreage? So Acreage obviously has gotten a lot of notoriety, probably due to former Speaker of the House, John Boner. He's involved with Acreage, right?
He is. I believe he's on the board.
Yeah. And then let's see.
Their trading history is not going to be as long. They did their RTO, or their reverse takeover, in November of 18.
Okay, let me pull up what I have on Acreage. I just Googled Acreage, and let's see. They're based in, it says they're domiciled in British Columbia, but they're headquartered in the U.S. Yeah. Take a look at what they are. You've got, obviously, John Boner is a little conflicted.
Right. Well, actually, I did a blog post on and I used his tweet about how he was changing his stance on legalization and things like that. And he kind of took an angle that he has to do it for the vets. And that's kind of the angle he took, and that's his double down stance. And I'm like, okay, all right, fine. It's just frustrating because I felt like, you know, when he was in there, he was very much against it. And then as soon as you come out on the private, where you actually had the ability to make some changes, and then when you come out on the private side, then all of a sudden you're like, rah, rah, cannabis, you know, I can't get enough. When there's a money-making opportunity. So I just think it's a little disingenuous.
I guess at the end of the day, it all boils out to the dollars, right?
Passions, rather than worry about how to pay for long-term care. Bright House Smart Care is a hybrid life
I've got some ads running on the background as we look at these sites. So interesting. So if we're looking at Acreage, so we looked at Curaleaf earlier. Let's go back and pull up Acreage right now. Okay, we're looking, you said market cap, it's $2.3 billion. How are their financials? Are they any better on the financial side, or are they pretty weak?
I think they are a little bit better, if I can recall. I haven't taken a look at it.
There's actually John Boner. So he spent 35 years in the political arena opposing the legalization of cannabis. Mm-hmm. But recently he's had a big change of heart. What are you going to say, right? What are you going to do?
They should be coming up. They do I think they showed up when I looked at them at some point. And it may not be on this site. Maybe I looked somewhere else. Let me see. If I can come up.
Yeah, it looks like too many tabs are open on my end, so I'm just kind of crashing here. It's a little disappointing. I'm going to stop my screen share. Well, looking at, the market cap, it's $2.3 billion.
Right.
If we look at their financials, if they even exist.
Yeah, they definitely do, because I know I've looked at them, and I don't know if I actually pulled them on Yahoo Finance or I pulled them somewhere else, but I've definitely seen them. They're not shown on Yahoo Finance. So where are they?
Yeah, they're not on. No, they are. We have some results for the previous quarter. If I were to pull this up, I don't know if you can see my screen all right, but you can see it right here. You're talking $5 million in revenue. So these guys are
super small.
even smaller than Curaleaf in terms of actual traction, but they've got a lot of, they must have a lot of hype, or they must have big plans, right? Because, I mean, a $2.3 billion company on a $5 million business is
They're
pretty intense.
last I looked at them, there was something about them that was different, and I don't have my notes to reflect that, but there was something about them that said, okay, you have something going on. And it may have just been their hype with the former Speaker of the House kind of having that insider political track, because that is very important. But I don't know what I had. Like, I have, interesting. I looked at them and I said, okay, you have something. Or was it Green Thumb? I don't know. One of the two, they all blend together now. But I think there was something special about them that I said, okay, maybe I'm a little more interested in you. But we'll figure it out.
Well, they just reported earnings. Let me pull up this story. Acreage Holdings enters California dispensary market. So now I'm going to, once this loads, I'll stop my screen share. Get back to this. So we have their website here.
Okay.
Leading the way to safe and affordable cannabis to everybody. Similar viewpoints in terms of everything that's going on. Okay, they don't have Curaleaf's operations, but they have some footprint.
Right, and I think it's interesting that they're in Michigan, which is not where, like, because Michigan's market is relatively new.
Oh, okay.
So yeah.
Yeah, so
pull them up side by side to kind of look at them, because as you can see, the footprint isn't as deep as Curaleaf, but I think they actually have some in the middle that Curaleaf doesn't have, which I think maybe Iowa and Illinois.
Okay, let me go pull up Curaleaf again. Sorry.
And I was just looking, and this is kind of, I think this is probably what caught my eye, is that they released their fourth quarter revenues, and their revenues were up 300, over 300%, almost 400%. But their loss expanded. So again, this is like another cash run. They just run through cash. But I think that's maybe what caught my eye with them.
Yeah, so they acquired California-based Canna Inc.
Yep.
All stock deal for $11.5 million. Now they're in Canada. Okay, so this is their entry into California, and specifically into Oakland, because Oakland is a regulated market, it sounds.
That's where everybody seems to be like really focusing on.
So now, how does one, like, is there, maybe we probably need to develop some type of, there's got to be some sort of a weighting system that, one could put together, right? Like, how do I weight? Because these are all different. You can't just weight on revenues. So there's going to be some type of, is it dispensary market or penetration or brand weighting? I mean, I don't know. I mean, this is interesting.
Oh, there it is. Yes, perfect. So
we can compare.
So I think, to your point, I think that's actually worth exploring for us to really sit down and say, okay, what is our criteria based on what we already know? Because history doesn't repeat itself, but it does rhyme. Based on what we know, what would be a driver of business in the United States? And what factors should we be looking at? I think that's a really good kind of point to look into. And I don't know if you caught the side by side before you took down the screen share that, so Iowa, that Illinois, and that Michigan, that Midwest connection. And I think that's also something that caught my eye. The Midwest connection for acreage is there, whereas Curaleaf does not have that. You see that difference there?
Yeah. You got Illinois, Iowa, and Michigan.
Right.
Versus Curaleaf is just on the coasts.
Right. It has something like Ohio, Kentucky.
Ohio and Kentucky. Well, but in the grand scheme of things, the Midwest is really Illinois.
Right.
Illinois is the big city, some Indiana, and I mean, Wisconsin, Indiana still have issues, but this area right there. is where it's at on that front. Interesting.
Right. So that's what I thought was really, I said, okay, so I see that because again, I think we also need to look at different things that will differentiate these companies, because again, we don't have these revenue kind of components, which gets very difficult. And I mean, to a certain extent, we're painting with watercolors, just kind of like trying to come up with a pretty picture. It's just like, we'll put a little bit here, oh, look at that, we have a tree now. So it's kind of like that kind of that scenario. So it's really hard to come up with something, but I think if we did a little bit more paint by numbers, we might get a prettier picture.
Interesting. Huh. So if you're looking at acreage, you're looking at Curaleaf.
Now, Green Thumb is actually bigger than Acreage, and that the last I looked at them, Green Thumb was actually, by market cap, was smaller than Acreage. Not by much, but it was smaller. So they have kind of jumped into what I would call the number 2 spot, and their symbol is GTBIF.
Okay, let me pull them up.
Now, they're Chicago-based, so I'm always...
Backyard.
So they're from what I have on them, they're in 11 states, and they basically operate a chain of 73 retail stores. So I thought that was a lot. So I mean, that's kind of what caught my attention with them, is that their retail presence.
Yeah, no. Okay, so let's take a look at Green Thumb. So here we have Green Thumb. I've got their stock symbol up, and we've got their financials. Okay, definitely over 21.
Mm-hmm.
Yeah, like all people, pretty looking. They do have nice websites.
Yeah, they do have nice websites.
Let's see. Look at the locations. Okay, so compared to, let's just go back, right? Compared to Acreage, much smaller company from a footprint perspective, right? So you can see the little U.S. map here versus Green Thumb. 72 retail locations, though. That definitely stands for something, and they're pretty well across that eastern seaboard.
Yeah.
And let's look at the numbers. I mean, okay, now I like this better. I mean, I don't like the operating expenses, obviously, but I like the fact that, whatchamacallit, you're talking, 4 times the size of Acreage?
Yeah.
Looking at what they're saying now, what's their stock price and their stock chart?
Their price, they're $13.90 last I looked. Okay, they're
$13.70 a share.
So they've dropped actually during the course of the day, because I looked at them a couple of minutes ago, right before we got on. They are actually
so they're in line with the Curaleaf. They're a $2.8 billion market cap.
Right, and they've actually done a very large slide. If you look at their 52-week range, they are at $13, and their high was $25. So I wasn't really able to kind of jump in and figure out exactly what caused that dip. To me, that was such a substantial dip. I just that's not what I really expected from this particular company, especially now that we're looking at their balance sheet, kind of seeing what's going on. Yep, there it is.
It looks like it started pretty high.
Yep. And there it is.
And then it's, oh wow, would have been a great one to get in.
Yeah.
Right around December, January.
Mm-hmm. And it was a good time for a lot of companies to get in. And I think I was asleep at the wheel during that time. And I think a lot of people were.
Oh, no. Yeah, I was actually, I looked at it and I was going to put some money in and I just forgot. Kind of embarrassing, but it happens.
Well, these are definitely on my radar. And they're always on my radar. So I'm just kind of like, how did I miss all of this? And I mean, now granted, I have been very Canadian biased. But I mean, even with our conversations and this conversations I've had with a lot of my students, I'm just like, they're at this point where they're just too expensive. They're just too expensive. It's kind of like that Mercedes with like, now we're starting to have transmission problems. So.
So let's take a look, right? So we've got the charts. So Green Thumb at one point was worth a lot of money, but now they're down a little bit.
Right.
Their revenues continue to grow on a pretty impressive clip. Looks like they've got plans of world domination, but don't we all?
Yeah, yeah.
So now, how do we turn that around, right? We've looked at Green Thumb, and you like Green Thumb because of their retail presence? Is that the main thing, or?
Yeah, I think their retail presence is pretty impressive, especially looking at kind of how small, I mean, their footprint is. Now, I am any company that is a U.S. operator that's not operating in California is always going to get like a minus from me.
Really? Why is that?
Because I feel like at the very minimum, and this is kind of across the board, if you can deal in California's like regulatory nightmare, you can like live anywhere. It's kind of like if you can make it in New York, you can make it anywhere. Like if you can make it in California and they're nonsense, you can make it, not nonsense, but they're like their regulatory web, you can make it anywhere. And I think that's a really good test of a company and how they're able to operate. And I don't see that Green Thumb is actually there. Now they're in Nevada. And I think Nevada, to me, and this is just my opinion, that I feel like they're a little bit more loosey-goosey. Kind of just like, hey, we have marijuana on the strip. Like this is kind of like, they have an idea of this destination type of, I guess, adult wonderland. So I don't expect them to kind of be so cracked down so hard. But you haven't moved into California. So I'm kind of like, well, not how serious are you, but like how good are you at this, if that makes sense? But their numbers are good. So I think that's an important aspect, an important thing to look at, that their numbers in terms of revenue growth is good. But again, I just always kind of give somebody like, oh, you get a minus. It may not be kind of like, I'm not going to mess with you at all, but it's still kind of like, when you get into California, when are you going to go there?
Yeah, so you look at Green Thumb and you look at Curaleaf,
Mm-hmm.
and they're about the same size, and they're running at similar multiples. And then you've got Acreage, which is a fraction of the size today from a revenue perspective, which is at an obscene multiple on that. So how do we, I mean, you're right. There's definitely some, that's probably a good project to discuss for next week. So anyone tuning in, there's definitely got to be some type of weighting system or some sort of evaluation system. So like, what would I look at?
Mm-hmm.
I would, obviously you want to start with revenues. Maybe you add a California factor, right? If you can function in California, you get you get a point for being in California. Obviously, the market sizing would matter too, right? Now, that'd be interesting, right? Would you prefer if someone was doing $20 million in just Florida alone and killing it versus someone who's in 15 different states and is doing 10 million, which one's better? Like one person's gone deep in the market, the other person's just going for the land grab.
I think we have that. Don't we have that in Liberty? Liberty is is like a Florida only retailer.
Oh, is that? Okay, let me go look them up. What are they called?
I think Liberty Health Sciences. It was actually one of the companies that was brought up in the conversation on CNBC. I think they're only in Florida.
Oh, okay. Let me see if I can pull them up. I got to close some windows on my end. And while we're waiting, you want to maybe just give people a quick overview of Liberty, what they're about?
I really don't pay them
Oh, you don't know?
Any mind, because I felt like they were only in one place, and I just, as much as you tell me how deep you are into one place, that always concerns me in terms about you're going to max out on your customer. To me, and now you have other competition, and then at some point, once we do hit legalization, whenever that is that these multi-state companies are going to be able to leverage their other states, and you don't have anything else to leverage. You don't have anything else to bring to the party. So I don't care how deep you are in one particular market, you're going to hit a max out point at some point, whether close, a lot sooner than these other multi-state operators, if that makes sense.
Oh, wow.
So I'm just kind of like, I think it's them, or is it another one? I'm pretty sure it's Liberty, though.
There's Liberty, and then there is Trulieve.
Yes.
So why don't we pop them up here? What is this? What are they? Liberty Health Sciences. So I'm pulling them up here. Liberty.
Okay. So tell us about the opportunity. I'm just trying to see where they are.
I think I have too many tabs open. Man, so it's just not working for me.
It does happen. Where is it? Well, Liberty, as a point, as you're like looking them up, they're actually very small. Their per share price is 70 cents per share, and their range was 47 cents to $1.27. That was their 52-week range. Now that was 70 cents maybe about 3 hours ago, so that may be a little bit different. But I'm trying to figure out. Or was it True Leave? So one of the two, either Liberty or True Leave, or one of them is only in Florida. And I'm just trying to remember which one it was.
Well, Liberty has seen better days. It's definitely down a little bit. Let me go share my screen on this end. While we take a look at Liberty. I got a good looking site. Yeah, well, they are definitely, you can see they are really Florida focused.
Yeah, they're just Florida. And it just always concerns me across the...
They have not been, they've definitely felt it on the stock price side of the equation. Let me see if I can look them up here. LHSI. So they've been going deep into the Florida. Now, Florida itself is a pretty big market, though.
Yeah, it is a big market. I don't want to underplay, the size of Florida's market. And I think that also kind of goes to a lot of things that we talk about overall in cannabis in terms of the aging population. That's kind of where a lot of the bumps are going to come from. It kind of the bumps in terms of like upticks, because that's the largest population that is looking for kind of alternatives to medicine, because they're being medicated so much because of, age. So I think there is some value there. But again, I'm always wary about just a company that just functions in one state.
While it pulls up, let's take a look.
Is that them? I think I'm looking at True.
Okay, well, I mean, their market cap is interesting. Well, their market cap definitely reflects a big difference, right? We're looking at a $255 million market cap.
Right, and Kush bottles is bigger, is almost 2 times, actually, like 2 times as large as this particular company, Liberty Health Sciences. So I think that's always very interesting.
Yeah, I mean,
for people
we're looking, what is this? $3 million. So what, 3.1 times 12? That puts them at 12 million a year. So it's still pretty, I guess, I think these US guys, you can't look at the revenues, because that's still, I mean, Can't Trust is still cheaper in terms of price to sales than even this small guy here. I mean, wait, let me just add this up. 3 million, 12. Yeah, that's 20 times annual revenue for their market cap. Jeez. Seems expensive to me.
Yeah.
Wow.
At what value? I mean, it's expensive, and then really what value, what differentiator what do they bring to the market that's different? I think that's always going to be the question. And I'm not really sure what that answer is.
Yeah, I guess, that's interesting. I could see both, right? Like, but maybe Florida's not the market. Maybe it's California or one of these places.
Well, I think California is interesting and tricky, because it does have a very big regulatory scheme. And when you have regulatory schemes that are large, you have a lot of costs in terms of taxes, or in terms of, it's really just taxes. And one of the complaints of the California market is that they, people who are actually want to be on the legal side, they're like, I want to get my weed legally, is that it's cost prohibitive. So
because of all the regulatory, the taxes, and all that sort of stuff.
So I think it's kind of like six of one hand, half dozen the other. I want to see that you can function in California, but I can also see you not wanting to kind of pick up and then actually move an operation there, as opposed to acquiring something that's already set up there and having that footprint there. Because California is still a very large market, but they're just not getting these numbers together that actually makes it a better move to buy not on the black market.
Okay, now let's take a look. Speaking of California and speaking about the Apple Store, let's take a look at your MedMen, which you seem to like a lot.
I like their vibe. I can't say that I really like anything other than that on their vibe. I think they have just a fun experience, and I think it does make a difference, but I'm not really sure about anything else with them.
Well, MedMen has a valuation in play. Valued at about $1.5 billion.
Okay.
So let's see where their revenue's falling at. I think we're pulling that up right now. Huh. Now they're actually moving some dollars. Yeah. $30 million a month now. Wow. Holy operating expenses.
Yeah, those are the problems. I mean, and I think I think that's the problem. But I think some of the problems that we see in the cannabis space are kind of everywhere else. I mean, if you can go virtual, a lot of people are going virtual because you don't want to take on the expense of this retail space or this kind of like physical plant. And I think to that point, they have Treehouse. So they're spinning off all of their retail. I mean, excuse me.
Oh yeah, the REITs and everything. Yeah, I know. Yeah.
Off their REITs, their real estate into this Treehouse REIT, where they're going to do a lease buyback. So basically, they're going to lease the property, and I think it's the net lease that they're engaging in. Is that they're going to basically pay for all the incidents of property. So just like they would be an owner, but they aren't the owner, they're actually engaging in a lease. But I think one of the things that are really important is that if they're having such a problem with operating expenses, you're going to get an infusion of cash, because remember, we're looking at these kind of more non-traditional ways to infuse cash into a business. So we're spinning off kind of this real estate and hoping to kind of get its own legs. But in the end of the day, are you going to increase your operating expenses by paying lease amounts every month as opposed to when you weren't before? So what does that look like? And the two that they're actually working on doing a spinoff are two facilities that are actually not operational yet. They're both in Vegas that I can think of.
Well, they get the benefit of capital, though, right?
Yeah, they do, and there's a real live benefit to that. So I don't want you to think that I'm kind of underplaying that, but I think, again, if we're having an operating problem, kind of the way they're, in terms of the money that they're spending. Now, what are we looking at now that you're going to add something to your operation when you do get the ability to have more cash so you can kind of expand your operations, but what does that look like over the long term?
Well, this is going to be a fun little, I don't want to say project because that sounds, but really, like, I'm looking at this, right? We've looked at MedMen today. We've looked at Liberty Health. We've looked at Acreage, and we've looked at Green Thumb. And it's fascinating. I mean, at first I say look at MedMen, and if I look at just price to sales and stuff like that without even knowing more about it, they're trading at 11 or 12 times annual revenue. I'm not saying potential isn't great, right? I like having market share, but there's something about if you're doing business and dollars are flowing through your doors, right? You're real, right? You can talk all the hype you want, but when someone pays you cash and buys stuff from you, that means something.
Right.
And now these financials are, I don't even know what to say about these financials. I mean, talk about like absolutely atrocious without digging into them. I mean, losing $60 million. Yeah, I mean, wow, that's crazy. But, I mean, they've got revenues. And you've mentioned their stores are pretty catchy. And ultimately, this cannabis thing is about some type of, call it consumer brand or some element of, yeah, no, it's definitely about one of those angles. So, this will be a fun little conversation to have as we dive into this further. I don't know if you saw this. I actually pulled up all the charts.
No, I didn't get a chance.
On the MedMen side. So here we have, you can see their numbers. Wow, so they were actually pretty high at one point.
Yeah.
High as $7. Now they're down to $2, so they're half of where they were at. So their market cap is half of what half of Curaleaf. And their revenues are their revenues are basically on par with Curaleaf.
But they had a huge expense.
Yeah.
So I think in terms of their positioning and the spinoff of these REITs, I think that's a great idea based on their model. But my only concern is, and my continued concern is it sustainable? This new model, is it sustainable?
Because you could, without knowing, my first gut reaction would be their SG&A is so high because they're offering this beautiful curated store experience, right? And does that really pay off? Or do you just, give them their bud and let them pick it up and call it a day?
Right. And I mean, and they're still basically still maintaining the property as if they were owners per what their leases are going to look like. So again, it's kind of like, yeah, I get what you're doing. You spun it off, not necessarily, you spun it off because you need the cash. And you said, well, what non-productive asset do we have that we can spin off? And that's what they have. That's essentially what they had. They had their stores. And I think it's an ingenious kind of move, but I'm just wondering is this kind of model sustainable? Because the way they're running through cash anyway, like, are we just going to get back to zero in a couple more months or a year?
Yeah. Wow. Cool. Well, these are some good starting points, I think, for people who are still tuning in. Next week should be interesting. You've got me thinking. Let's try to put together some type of comparative metric, because you look at you can't look at any of these things. Like, they're all different numbers. They're all over the place. I mean, I actually want to investigate this further. This seems kind of fun. Cool.
I think we'll have a lot of fun next week.
Alrighty. Well, everyone who's on, thanks for tuning in. And until next week, we'll see you guys around. Bye-bye.